All right, in this video, we're going to continue our discussion on inter-entity transactions. In particular, we're talking about consolidation of inter-entity transactions and how do we deal with consolidations when we do have inter-entity transactions. Now, we're specifically talking about non-controlling interest. Now, when we talk about non-controlling interest, what we're talking about is a situation in which I, as the parent, decide to buy a subsidiary, but I can't acquire 100% of ownership. And that could be many reasons. Maybe all of the owners, except for this one shareholder, don't want to sell their interest to me, and so we still want the interest in this company, so we're going to buy out everybody except for that one owner. Maybe we are buying it out, but we're leaving the owner with a percentage because they are the founder, and so we still want them retained within the organization. So there's a lot of reasons why we have these non-controlling interests. The question that we're trying to answer in our problems is, what's the net income attributed to the non-controlling interest? And the reason why we're saying that is because, in our case here where we have Mickey and Donald, Donald's going to make money, okay? And if Donald's going to make money, that money is going to be also Mickey's profits and money, except for the part that Mickey doesn't own. So if Mickey doesn't own 15% of Donald, that 15%, that net income, 15% of that net income is not Mickey's. So that's a non-controlling interest amount. Now, in equity method of accounting, we have to consolidate them fully. So we consolidate them fully as if Mickey owned 100% of Donald, and then we subtract on the financial statement this amount called non-controlling interest. So that's what non-controlling interest does. Okay. Now, in our last example, we just assumed that Mickey owned 100% of Donald. But as an example, let's assume that we've got Donald here and Mickey owns 85%, but this guy here, Pluto, owns 15%. Okay, and so Pluto owns 15%, Mickey owns 85%, and so Mickey owns this 85%. Which also means that 15% of the profits that Donald has doesn't belong to Mickey. Therefore, we need to calculate that amount out. And so we're going to show you how to calculate that amount out based on what we know in this chapter and in previous chapters. So to start with, we first need to figure out, okay, how much of Donald's profit is not Mickey's? That's what we're trying to answer. The first thing we have to do with Donald is figure out what its profits were for that year. And so we go back to financial accounting and we start with sales. Well, Donald had sales of $425,000. In addition, Donald had cost of goods sold of $175,000. And Donald had operating expenses of $95,000. That gets me to $155,000. Okay? So we've got $155,000. Now we also have something else to contend with. We have the excess amortization that we have to contend with, and that's because we purchased it from Donald at an excess amount. So we've allocated the excess of purchase price to equipment, and so we have an expense here of $30,000. Okay, so we have $125,000. Okay, there. Now, we're going to do it this way. There's more to it, but we're going to try to get to the answer. And really, this part should be somewhat a review, so we don't need to go into why I'm adding the $30,000 because, in reality, that non-interest doesn't have interest in that $30,000 per se, okay? But we get to $125,000. Now, there's one thing that we have to contend with, and this is where we're going to deviate in our calculation of net income attributed to non-controlling interest, and that is the idea upstream and downstream. Now, as a review, downstream is when the parent sells to the subsidiary inventory. Upstream is when the subsidiary sells to the parent inventory. Okay? Now, why does this matter? Well, let's take a look here. Remember that we deferred $5,000 of profit here. Okay? When we deferred that $5,000 profit, the real question is who's deferring that $5,000 profit? Well, if we take a look here, in a downstream situation, we said, you know, Mickey sells to Donald on a downstream inventory, but if Donald doesn't sell it to a third party, it's as if the transaction never happened. Well, who did the transaction really not happen for? Well, the who is Mickey. It's as if Mickey's transaction never occurred. Now, I know that there is a journal entry that Donald will make, but it's as if Mickey didn't have a journal entry, okay, or a sale. And so they're showing a bigger profit when they shouldn't be, okay? So in a downstream situation, Mickey is showing this $5,000 profit that they shouldn't be. Now, in an upstream, Donald is the bearer of the transactions, and when they sell it to Mickey at the end of the year, if Mickey doesn't sell it, it's as if this profit over here for Donald never happened. Okay? And because of that, we have different situations to do with upstream and downstream. Now, the easiest one that we can start with right now is downstream. In a downstream situation, we've got Mickey here who's deferring the $5,000, but it's just Mickey that's deferring the $5,000, which means for the non-controlling interest, they're not a piece of that $5,000. They're not a piece of that non-controlling interest because Mickey is deferring it, not Donald. Okay? And those 15% don't own Mickey, therefore the $5,000 doesn't mean anything. So if this is a downstream calculation and we're trying to figure out net income attributed to non-controlling interest, we simply take our number here and multiply it by the non-controlling interest amount. Okay? In this case, $125,000 times 15%. Now, if we do the math, I get $12,500. Half of that is $6,250. So we get $18,750. So that gives me $18,750. That's my net income attributed to non-controlling interest. Okay? We're done when it comes to downstream. Now, upstream has one more calculation, and that's why I'm leaving it to last. This example here is downstream. So we would be done here, $18,750. But let's assume this is upstream. And with upstream, we're saying we're going from Donald to Mickey. Donald has to defer the $5,000, but guess what? Because Donald has some other owners, Pluto, it's as if they also need to defer the $5,000. And if they have to defer the $5,000, we also need to subtract $5,000. So we start with our 125, subtract that deferral of $5,000, we get 120, and then from the 120, we calculate our non-controlling interest. Our non-controlling interest is 15%. So 15% of that, and we get $18,000. Okay? So in a upstream, our answer would be $18,000. In a downstream, our answer would be $18,750. Okay? I know it's a small difference. The difference is only $750, but it's because of who's a part of that $5,000 deferral right here, this bottom one right here. Well, if Donald's going upstream, Donald's got to defer that $5,000. If Donald has to defer that $5,000, that 15% interest over here also is deferring a part of that $5,000. If it was flip-flopped, going downstream, Mickey, Pluto doesn't own Mickey, therefore that $5,000 deferral doesn't affect him on that side. And so if that's the case, then we're going to not subtract the $5,000. We'll keep our 125. We'll multiply by 15%, and we'll get $18,750. So again, in this video, we were trying to address this idea of net income attributed to non-controlling interest. It gets a little bit confusing when we talk about down and upstream. Hopefully this video kind of shows you the minute differences between upstream and downstream, and it really is minute. It's that $5,000. It's that deferral because of the third party not getting, or not the one of the parent or the subsidiary is not selling the goods that had an intra-entity transaction to a third party. So hopefully you get that. Hopefully this makes sense. That will complete one of your examples. In the next video, we'll go through another kind of discussion of how to solve that problem, and we'll see you in that video.